Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Chegg stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a micro cap company, 200 million market cap. They're trading at $2 a share, and they have 100 million shares outstanding. Chegg operates a direct-to-student learning platform. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow was consistent from 21 to 23. It dropped 50% in the trailing 12 months. It's down to 83 million. They did have really good margins. Now they're down to 12% margin. Net income is the profit or loss on the income statement. It's revenue minus expenses. A small negative in 2021. It blew up to 267 million in 22, down to 18 million in 23. A big negative in the trailing 12 months. They must have had a big asset impairment, probably a goodwill impairment, since they have a big negative and positive free cash flow. Revenue is sales for the company. Now, it looks terrible. It goes down every single year from 776 million to 680 million. We estimated 4 years of future free cash flows. We also estimated the terminal value. It's all cash flows past year 4. That's 1.3 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1 billion. We divide that by 100 million shares. And we get a calculated stock price of $10. They're trading at $2, so they're trading at a 79% discount. It's a really, really strong buy according to the model. Do you think it's a buy or a sell? Let me know in the comments. As usual, Simply Wall Street is really bullish on this one. $19 a share. They say they're 89% undervalued. There are 42 companies in the same industry as Chegg, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend a lot more than median and average in CapEx, 95 million. Their real leverage, 1.7 debt to equity ratio. For every dollar of equity, $1.70 of debt. They're still generating positive free cash flow, 83 million. It's more than number 11. More free cash flow than the 9 companies higher than them in terms of market cap. They rank 20th in market cap. They're trading at 0.6 times book value. The only company better is Vasta Platform. We can't look at that PE, negative earnings. They have the best price to free cash flow, 2.6. The best price to sales, 0.3. Revenue of 680 million, which is the most revenue on this list in terms of their market cap. And the way I know that is price to sales ratio. And their 5-year annual revenue growth rate is 14%. But we saw in the last 3 years, it's negative. Here's their latest income statement, the second quarter of 2024. Revenue is down from 183 million to 163 million. Cost of revenue is only 45 million. That's also down. So gross profit, 118 million. R&D, 44 million. Marketing, 24 million. G&A, 54 million. That big impairment, that's what it is. It's probably a goodwill impairment, as I mentioned earlier when we look at their financials. So operating expenses over 600 million. Operating loss, 485 million. But you should strip out this 480 million. They actually have positive operating income if you strip that out. Because that's really a one-time item. And it's a non-cash item as well. So they had a net loss of 600 million. But look at that, they're buying back stock. It was 118 million, now it's 103 million. I was really negative on this company until I saw that. So it doesn't actually look as bad as I thought. So to summarize, I have them trading at a 79% discount. I rank them 7 out of 10 because they seem so undervalued. This is almost the definition of a value trap. Would I buy a 3 out of 10? It looks really, really appealing, but I don't think I would buy it. Ratios 8 out of 10. Amazing price to free cash flow and price to sales. But financials 2 out of 10. Revenue down 12% since 2021. Free cash flow down 54% since 2021. It's kind of a crazy company, right? Great ratios, terrible financials, really low would I buy them, really high ranking. Doesn't sound like it makes much sense, right? But those are the rankings. Don't shoot the messenger. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.